Yesterday felt like the end of the world. Screens were bleeding red, confidence evaporated, and silver did what markets always do when fear peaks. It punished conviction. In just a few hours, price collapsed from euphoric highs, wiping out billions in paper gains and turning certainty into doubt. Many of you were frozen, staring at your charts, finger hovering over the sell button, asking the same question traders have asked forever. Is this the end? Is this? But today is not about fear. Today is about clarity. Because while most people were watching headlines and emotions spiral, the market itself was making a decision. When the session opened, silver did not continue falling into chaos. The selling slowed, the panic lost momentum, and at one very specific price, everything changed. That price was $75. Not $70, not some arbitrary midpoint. $75 became the line where fear exhausted itself and discipline stepped in. This was not random. This was structure asserting itself. This was intent. And this is the moment where inexperienced traders see disaster while professionals recognize a test. True breakdowns do not hesitate. They slice through support without resistance. What we witnessed instead was a violent shakeout followed by a precise defense. The kind of move designed to force weak hands out while quietly transferring ownership to stronger ones. This is how bull markets cleanse themselves without collapsing. Crashes destroy structure, corrections reinforce it, and what formed at $75 was not about a crack in the foundation, but a deliberate confirmation that the trend is still alive. If you understand why $75 mattered yesterday, you begin to understand why this move is not finished. The market spoke clearly. Most people just weren't listening. Before we go deeper, if this analysis is helping you see the market more clearly, support the channel by subscribing and drop a comment with one if you held through the volatility or two if yesterday shook you out. Now let's move forward, because understanding this floor is the key to everything that comes next. To understand why $75 held with such precision, we have to step back and look at history, not headlines. Markets have memory. Price levels are not just numbers on a screen. They are zones where battles were fought, capital was committed, and psychology was shaped. And the $75 level carries more memory than most people realize. Go back to the early phase of this rally. Before silver ever exploded toward the highs, it spent weeks trapped below $75. Every attempt to break higher was rejected. Sellers defended that level aggressively. Volume piled up, frustration built. For a long time, $75 was the ceiling that refused to give way. Then when silver finally broke through it, everything changed. Momentum accelerated, sentiment flipped, and price left that zone behind with force. That breakout was not just a move higher, it was a regime change. And in technical markets, there is a rule that never stops working. Old resistance becomes new support. This principle is not theory, it is behavior. Traders who sold at $75 before the breakout regret it. Traders who bought the breakout defend it. When price returns to that level, both sides act at once. Sellers hesitate. Buyers step in. The market stabilizes. That is exactly what happened yesterday. The sell-off did not stop randomly. It stopped at the scene of the breakout. The market came back to test whether that level still mattered. And when it did, it held. This is what professionals call a retest. Retests are not bearish. They are essential. They confirm that a move was real. Weak trends fail retests. Strong trends pass them. While emotional traders saw a collapse from the highs, disciplined traders saw something entirely different, price returning to a structurally important zone where large players were waiting patiently, the ones who did not chase euphoria, the ones who plan entries weeks in advance. This is why context matters. Without it, every pullback feels like a crash. With it, corrections become opportunities. And this retest at $75 was not subtle. It was aggressive, fast, and defended with conviction, which tells us one thing very clearly: the market still respects this level. But price memory alone does not build a floor. To truly understand the strength of this defense, we now have to look beneath human behavior and into the machinery that actually moves markets today. Price does not move on emotion alone. In modern markets, it moves on math. More than half of all transactions are executed by machines that do not feel fear, hope, or regret. They respond to predefined levels, probabilities, and statistical triggers, and yesterday, silver collided with one of those mathematical boundaries almost perfectly. This brings us to Fibonacci retracements. Many dismiss them as superstition, but the reality is simple algorithms are programmed to respect these ratios. When a strong trend pulls back, the machines look for specific retracement zones where probability favors a reversal. The shallowest and most aggressive of those zones is the 23.6% level. When you measure the entire rally from its November lows to the recent peak, that 23.6% retracement sits just below $75, and yesterday's low stopped just above it, not by dollars, by cents. That detail matters. In weak markets, price blows straight through shallow retracements and searches for deeper discounts. It falls to the 38.2% or even the 50% level before buyers appear. But in dominant trends, price barely corrects at all. Demand is so strong that buyers step in at the first mathematically acceptable opportunity. That is what we saw. The market did not allow silver to fall into deeper retracement territory. Buyers front-ran the level. They paid up to ensure execution. That behavior is not fear, it is urgency. The same story appears when we look at moving averages. The 20-day average, which represents the recent consensus price, sat well below yesterday's low. In a normal correction, price returns to that mean. Yesterday, it never came close. It floated above it. This phenomenon is called front-running the mean. It happens when institutional capital is competing for exposure and refuses to wait for perfect prices. They would rather pay a premium than risk missing the trend entirely. When price holds above key averages and defends shallow retracements, it tells us something critical: the trend is not slowing down. It is compressing energy. The machines saw their signals. The funds saw their models confirm, and together they reinforced the same conclusion at the same level. $75 was not defended emotionally, it was defended mathematically. But math alone does not hold a market. To see how deep this floor really goes, we now have to look at the one thing that cannot be faked: volume. Volume is the truth serum of the market. Price can be manipulated. In the short term, narratives can be spun, but volume reveals intent. It tells you where real commitment exists and where it doesn't. And at $75, the volume profile tells a story that is impossible to ignore. Over the last several months, the heaviest concentration of trading activity sits directly in the $75 zone. This is what professionals call a high-volume node. It represents an area where millions of contracts changed hands, where positions were built, defended, and emotionally anchored. When price returns to a high-volume node, it does not move freely. It slows down. It gets absorbed. That absorption is exactly what we witnessed. Selling pressure hit the $75 area and began to disappear. Not because sellers suddenly felt optimistic, but because there was nothing left to sell into. Every wave of supply was met with demand. Think about the two groups trapped at this level. The traders who bought around $75 earlier in the rally watched price explode higher. When price collapsed back to their entry, they were not afraid. They were relieved. Their instinct was not to sell, but to defend. At the same time, traders who sold or shorted near $75 months ago had been suffering. They watched price run away from them. Yesterday, the market handed them an escape. They bought to close. That is buying pressure born from regret. When buyers defend and sellers cover at the same level, price becomes sticky. It turns into a sponge that absorbs selling without collapsing. This is why massive sell orders can hit a high-volume node and barely move the market. This is not magic, it is mechanics. Regret on one side, conviction on the other, both expressing themselves through volume. And when a market absorbs pressure instead of breaking it, signals strength. Weak markets collapse under stress. Strong markets digest it. The defense of $75 was not quiet. It was heavy, contested, and decisive. That tells us this level is not fragile. It is reinforced by memory, by capital, and by emotion. But even volume does not tell the full story, because while price was stabilizing, something critical was forming on the chart itself, a signal that traders have respected for decades. To understand whether this was truly the end of the selling, we now have to look at the shape of the battle. Markets leave footprints. When buyers and sellers clash, the outcome is written directly onto the chart. And yesterday, at the exact moment silver tested the $75 floor, the price action carved one of the most recognizable reversal signals in technical analysis. On the daily chart, a hammer candle formed. This pattern is simple but powerful. Price opens under pressure, sellers drive it lower, and panic spreads. But then the dynamic shifts. Buyers step in, absorb the selling, and force price back up toward the highs of the session. What remains is a long, lower shadow and a compact body near the top. It is visual proof of rejection. Silver did exactly that. Sellers pushed hard, attempting to break the floor and trigger a cascade. They failed. Every attempt to push lower was met with stronger demand. By the close, price had recovered most of the intraday damage, leaving behind a clear message: lower prices were refused. A hammer at a random location means little. A hammer at a major support level means everything. When this pattern appears at a well-defined floor, it signals that the bears have exhausted their momentum. They fired their best shot and could not hold ground. Momentum indicators confirm the same story. The relative strength index never collapsed into oversold territory. Instead of resetting to weak levels, it held firm in bullish range. That tells us buyers were stepping in early, not waiting for deep discounts. This behavior only appears in strong trends. Weak markets need extreme oversold conditions to attract buyers. Strong markets attract demand while momentum is still elevated. Under the surface, volume reinforced the signal. Selling pressure faded as price approached $75 while buying volume expanded during the recovery. This is classic accumulation behavior. Institutions allow the panic to burn itself out, then quietly step in. When candlestick structure, momentum, and volume all align at the same level, the probability shifts. The odds move away from continuation lower and toward stabilization and reversal. This was not a dead bounce, it was a rejection. But technical signals alone are never enough. To know whether this floor can hold, we must identify who was actually buying. Because markets do not turn on patterns, they turn on capital. To find the answer, we follow the money. Following the money removes emotion from the equation. Patterns can fail, opinions can mislead, but capital always reveals intent. And at the $75 level, that intent became clear accumulation, not escape. As price stabilized, selling, pressure faded while exposure quietly returned. This divergence matters. When price holds, while participation improves, ownership is shifting. Weak hands exit under stress. Strong hands enter by design. Institutions require liquidity to build positions, and panic provides it. Yesterday's sell-off created the conditions they wait for. Retail traders sold emotionally. Larger players absorbed patiently. More importantly, the buyers were not speculators. They were industrial users. Companies that depend on silver for production do not trade momentum. They manage supply risk. As price surged higher, many stepped aside. Below $76, their economics changed instantly. This is the industrial bid. When silver enters a cost-effective zone, physical demand activates. Factories cannot wait for perfect charts. Inventory matters more than timing. At the same time, commercial hedgers reduced short exposure. These players normally lean against rallies. When they stop pressing lower, it signals downside is limited. Investment flows stabilized. Industrial demand activated. Commercial pressure eased. 3 independent forces converged at $75. This floor was not emotional, it was functional. But strong floors still face tests, especially when the threat comes from outside the market itself. And the next challenge has nothing to do with silver. Macro forces. Now, we have to confront the risk still hanging over this market because no bullish setup exists in isolation. Even the strongest technical structures are tested, and the greatest threat to the $75 floor does not come from silver itself. It comes from macro pressure. Silver trades in the shadow of the US dollar. When macro events hit, correlations tighten and algorithms take control. In these moments, price action becomes mechanical, not emotional. Funds rebalance, models adjust, and silver can move sharply without any change in its underlying fundamentals. A hawkish tone from policymakers can ignite a rapid dollar surge. If that happens, silver may experience another violent test of support, not because the floor is weak, but because cross-market flows temporarily overwhelm structure. This is how sudden spikes lower occur even in strong trends. These moves often create false breakdowns. Price briefly slips below support. Stop losses are triggered, leverage is flushed, and fear spreads. But without follow-through, these dips fail. They are designed to test conviction, not signal collapse. The distinction that matters is acceptance. Floors are not broken by intraday volatility. They fail only when price spends time building value beneath them. Sharp probes that immediately reverse do not invalidate support. They reinforce it. As long as silver does not remain below $75, the broader structure holds. Volatility alone is not a verdict. It is a stress test of positioning. If macro pressure fades and the dollar fails to accelerate, the path forward opens quickly. The energy compressed during this consolidation has only one direction to release. And to understand where that release points, we now move from risk management to opportunity mapping. With the major risks defined, we can now shift our focus forward. Markets do not reward those who only identify danger. They reward those who understand where pressure resolves once uncertainty clears. And when a strong floor holds, the next move is rarely random. The first area the market must reclaim is the mid-range resistance just above the consolidation zone. This is where trapped sellers from the breakdown attempt will look to exit. As price moves higher, their supply becomes fuel. Each recovery step forces more covering, accelerating momentum. Once that zone clears, attention returns to the previous highs. Highs are not barriers forever, they are magnets. After a violent shakeout, markets often revisit extremes faster than expected because positioning is lighter and conviction is stronger. This recovery does not require new optimism, it only requires stability. When fear fades and price stops threatening downside sideline capital returns, that flow alone can drive price higher. The structure beneath silver now supports this path. Higher lows remain intact. Momentum remains elevated. Buyers have demonstrated willingness to step in early rather than wait for deep pullbacks. This creates a stair-step dynamic. Sellers meet buyers higher. The floor rises. What began as defense becomes acceleration. But targets are not promises, they are probabilities. The market will still move in waves, pullbacks will occur, but as long as they remain shallow and defended, the trend remains intact. Understanding this allows discipline. It prevents chasing strength and panicking during noise. With the path mapped, we now need to step back one final time and extract the lesson this market is teaching. Because the difference between success and failure is rarely the trade itself. It is how one responds to volatility. Every major move in the market carries a lesson, and the sell-off we just lived through was no exception. This was not merely a price correction. It was a psychological event designed to separate reaction from discipline, and how you responded to it says far more about your long-term success than the outcome of any single trade. Volatility exposes behavior. When price collapses quickly, fear compresses time. Decisions feel urgent. The brain shifts from analysis to survival. This is where most traders fail, not because they lack intelligence, but because they lack a framework. Without structure, every red candle feels personal. Professionals approach volatility differently. They expect it, they plan for it, they understand that strong trends require periodic violence to reset leverage and flush excess optimism. Without these events, markets become fragile. Corrections are not interruptions of bull markets. They are the mechanism that keeps them alive. The key lesson from the $75 defense is patience under pressure. The market tested conviction precisely where doubt was highest. Those who understood structure saw opportunity. Those who followed emotion became liquidity. This is not about being right or wrong. It is about positioning. Successful participants do not need to predict every move. They need to survive volatility without self-destructing. That requires predefined risk respect for levels and emotional distance from short-term noise. Another lesson is selectivity. Not every dip is a buy. Not every rally is strength. Context determines meaning. A drop into structural support during an intact trend is not the same as a breakdown from distribution. Knowing the difference is what separates trading from gambling. Markets reward preparation, not prediction. And this episode reinforced a timeless truth. The hardest moments to hold are often the most important ones. With that understanding, we can now step back and look at the bigger picture. Not just where silver might go next, but how to navigate markets like this moving forward. That brings us to the final chapter. What happened at $75 was more than a technical reaction. It was a lesson in how markets truly operate. Price does not move randomly. It reflects structure psychology and capital interacting under pressure. When you understand that volatility stops feeling chaotic and starts becoming information. The first strategic takeaway is simple. Strong markets do not collapse easily. They test conviction, shake leverage, and intimidate participants, but they do not abandon structure without resistance. When a floor forms through multiple confirmations, it deserves respect, not blind faith. The second lesson is discipline over prediction. You do not need to call exact tops or bottoms. You need to define risk. Levels matter because they tell you where you are wrong. Without structure, every move feels dangerous. With it, uncertainty becomes manageable. Third, patience is a competitive advantage. Most participants fail not because they misread direction, but because they cannot tolerate discomfort. Markets are designed to punish impatience and reward preparation. Corrections are not enemies of bull markets. They are the cost of participation. Upside requires volatility. There is no reward without friction. Silver's defense at $75 revealed where conviction lives. Your